Mahesh Nandurkar, Head of Research and MD at Jefferies, joins into the show right now to perhaps make sense of the madness. Mahesh, I'm wearing red in solidarity with the market sentiment, and I think more than asking what the markets are up to, how are you feeling looking at the screen?
Well, obviously it's not a pleasant sight to be looking at the markets this way, but it's not actually unexpected, to be honest with you. I think this whole year is going to be a weak year from the returns perspective. And while the markets have seemingly corrected to less than 16,000 as we speak on the Nifty, I really don't think that, we'll still be making positive returns from here on in the remainder of the year.
Mahesh, I was chatting with Chris Wood the other day on the sidelines of your conference in Delhi, and he said that he's going to upgrade India or increase India weightage rather when he sees a level of 14,000 or 14,050 on the Nifty. Seems like that's surely going to be coming up next and maybe coming soon.
Yeah, so what's happening, is clearly that, if you look at the Indian markets, we are down maybe like just about 8-9% YTD, right? And if you compare with most of the other global indices, including S&P and Nasdaq, etc., they're well down like 20% and 25%. So India is actually still being a relatively big outperformer, so to speak. And from the regional context, what we are seeing is that there is some bit of opening up of news flow coming in from China, and that's a market which has corrected quite a lot. So, even at our investor forum last week, which was actually a pleasant sight because we had our physical event. I would say probably the first physical event of such size that we've seen in the last 2.5 years. So good to see both the companies and the investors actually traveling in from abroad as well. But yeah, so what I was saying was that while people are willing to travel, but I think clearly the news flow on the markets are still going to be, in my mind, a week.
Good morning, Mahesh, and I wanted to understand your outlook on this relentless FII selling pressure as well that we're seeing day after day. Do you believe that we are likely to see the sort of risk-off sentiment continuing and that the liquidity situation will remain fairly adverse for some more time to come, given what the factors that you're pricing in?
Yeah, true. The FPI selling has been relentless, but what we have seen so far, even in the last 6 months, or actually even if you take last 12 months, we've seen about 5% of FII stock in India getting sold, right? We are looking at a total FII investment in India of more than $600 billion. And what we've seen in terms of selling is about $30 billion, which is a substantial number. But let's remember that it's only 5% of the overall holdings, and also in the context of the relative outperformance of India. So in fact, I kind of said it, probably on one of our previous interviews that I would not be surprised if the FPI selling continues. But what would possibly be a sign of worry, and thankfully it's not been visible so far, what will possibly be a sign of worry is if the domestic investors who have so far been absorbing all the selling by the foreign investors, in a matching way, the worry will be that if we see some signs of slowdown on the domestic flows.
Good morning, Mahesh Nandurkar and Nayantara joining in. In fact, I wanted to build upon that point. You have the Central Exchequer, India's Finance Minister Nirmala Sitharaman, talking about the retail activity and DII as the shock absorbers for the FII sell-off, higher than the greater financial crisis. In the first 10 days of June also, it's been back to the brutal kind of sell-off. So, Mahesh, the dip in activity that we have seen when it comes to new demat accounts, the dip that we've seen when it comes to the SIP flows as well, is that likely to be the trend? Because if retail investors start to lose out money, and they lose out money on a one-year basis, they are likely to cash out.
See, so far the trend seems to be on the positive side, Nayantara. We just saw the the AMFI numbers for the month of May, which was pretty strong. But my worry is that, and my interactions with the investors reveals that when the trailing 12-month returns begin to go into the negative territory, that's the time when the retail investors begin to get worried, about the market returns. And we are probably, kind of almost at that point, or maybe we will hit that point in the next few weeks when the trailing 12-month returns will be zero or in the negative territory. And apart from that, what I see is that there is also a possibility, in my view, that given the strong trend that we're seeing in the property market, the physical property market, some part of the flows into equity markets can get diverted there. Although the demand in the property side as of now is purely end consumer driven or dominated by end consumers, but we might see some incremental movement from the investor community as well. So yeah, so those are some of the key points to keep in mind, and we definitely cannot take for granted the retail investor flows which have been supporting the markets for so long.
Mahesh Nandurkar, I'm going to ask you a question very, very crudely. You started this interview by telling my colleague Aisha that expect neutral returns. Right now, it's looking like it'll be great if we don't end the year with negative returns. It always looks scary when we are on our way down. My question, and I'm going to put it as crudely as I can, what is it that you're telling your clients to do? A no trade is, of course, also a trade. But having said that, with many certain foreign brokerage firms saying maybe it's time to increase allocations to China, the kind of risk-off that we are seeing globally, the way the markets are sinking globally across asset classes, barring property market, what is it that you're telling your clients to do with their money?
So what we've been talking about, Nayantara, is that at this point in time, there's a big dichotomy between the two cycles. One is the economic cycle, and I believe that, and I'm a strong believer that the economic cycle in India has bottomed out, which means that over the next 12 to 24 months, the corporate earnings, etc., would actually be pretty robust. But then on the other hand, the valuation cycle has clearly peaked out, and the multiples still need to go down from where we are. Now, the multiples can go down in two ways, right? One is that we get near-term market corrections, whatever, say 10%, 15%, something like that. And that brings the valuation multiples down to, where the rest of the world, has seen the kind of correction. That's one way. The second way is that we just see the market moving sideways, and the earnings growth catches up, and say over the next 12 months or so, we see a sideways market hovering at about, say, 16,000 mark, then that would automatically mean that the P multiples have come down by about 15%, because that's what the extent of earnings growth is going to be. So my view is that we should basically sort of be preparing for kind of a zero return, even over the next 12 months or so. So in terms of the sector selection, the stock selection, definitely some focus has to be there on the defensives, on utilities, the consumer staples. We also look IT services, because IT services has also corrected quite a lot, and we believe that the demand scenario from the US is not looking as bad as it's been feared. And also in the context of strengthening dollar and macro worries, etc., the dollar earning businesses should act as a hedge. So what we have been sort of highlighting is that reduce the underweight on staples, bring it up to neutral level at least, continue to overweight on banks, continue to overweight on IT services, and we also see value emerging in auto segment as well. So that's the sort of key message that we have been giving out.
It's quite interesting that you say autos, because outside of the sectors that you already mentioned, this seems to be a new one. What within autos then, Mahesh, interests you?
See, I believe that just like the what we've seen in case of the property cycle, which has been in a bad patch for the previous 7-8 years, and now we are seeing an up move on the physical property demand. I believe that something similar will be happening in the four-wheeler segment as well. The four-wheeler segment has been through a bad patch over the last several years due to a variety of reasons. But we believe that as the supply constraint slowly ease up and the replacement cycle begins to play out, I feel that the four-wheeler stocks should definitely get some positive drift out of this trend.
Interesting. Mahesh, this is going to be a tricky week considering you've got the FOMC as well meeting, and all indications are now at a 75 bips hike, not just restricted to 50. Given the kind of inflationary environment that we're seeing across the globe, A, wanted to understand what is your expectation from the FOMC, and then B, in that light, would you say that the RBI in some sense has been a little behind the curve?
From the FOMC side, our house view is that there is still a lot of scope for the rates going up, whether it's 50 or 75 this time, but we will just not end there. And our house view is that ultimately we will settle, at the Fed rate of close to around 3.5 to 4%, say over the next 12 months. I think what will be interesting to see is that how the US stock markets react to that, because Fed would also be looking at the market reaction as well. The Fed will be looking at the economic impact as well. And maybe at some point in time in the fourth quarter of the current calendar year, there is a possibility that Fed could review its language, the Fed could review the pace of rate hikes, etc. But I think the market will not really be, would not really be sort of taking into account the possible moderation in the Fed rate hike and the language by the fourth quarter. I think we will take that as it comes. But as of now, as I mentioned, it's looking like that, we'll probably end at 3.5 to 4% as far as the Fed rate is concerned. And as far as RBI is concerned, I think RBI has raised almost by 130 basis points over the last one and a half months or so. And clearly there is going to be more rate hikes in the offing. But the yields have already moved up significantly. And while the RBI could possibly end up raising by another 75 or 100 basis points or so, I don't think that the bond yields are going to go up by that much. Maybe the bond yields go up by say another 25, 30 bips or so, something like that. So that's what we believe.
Nandurkar, I'm going to request you to just hang on with us. With the kind of cracks that we're seeing in the markets, we're reaching out to other experts for reactions as well. We're just coming back to you as well to have another important conversation, Mahesh, and that is of the premium that India continues to command versus the rest of the emerging markets and how it's been performing rest of the world. But Ajay Srivastava also live with us to help us understand and how our viewers can make volatility their best friend. Good morning, Ajay. We've given up on 15,800 for the Nifty, cracked more than 400 points in trade. The Sensex is down more than 1,400 points, trading below 53,000 at the moment. It's all global cues at play. Look at that red hot inflation data that has come out on Friday. Wednesday, the FOMC meet outcome is going to be known. What's your advice to all of our viewers who are tuning in, trying to understand this big sell-off, this brutal sell-off?
Well, I think, let's look at the silver lining for this sell-off. This sell-off is the required bleeding of the system, which was the old remedy for fever, if you remember it, is because the Indian market continued to be over-optimistic in spite of all the global headwinds, the oil at 120 and so on. I think this is the first time we are seeing a very generalized selling. And I think that's good for the market, that let the blood get out and let the weaker hands get out. And then you'll see whatever is left is a much stronger hands to hold on to equity. That is one. Number two, I think the play is going to be versus FI stocks versus non-FI stocks now, because the FI stocks may still continue to kind of just show a gradual bleed. I don't think it's going to go down dramatically now, given the valuation paradigm we are in at this point of time. So, in a sense, I would say if you have not sold off, I don't think it's a good time to sell. But if you want to buy, I think you still have the luxury of trying to buy. That's, in a sense, the story of the market today. But I'm quite heartened with the market situation that now we are finally recognizing the global reality and accounting for in our share prices, which makes sense as the market heads to literally making a bottom. Whether it does a V-shaped recovery or steady is a different matter. But I think now we are heading towards a situation where we could actually visualize the bottom.
Okay, we can visualize the bottom. Mahesh, I'll come to you with that one. Chris Wood did give us a little bit of an idea of what the bottom could be. And But the fact is that India is continuing to outperform, right, the rest of the world, in the sense that we're doing better in the US, we've beaten Germany, we've beaten Hong Kong, the other geographies that we can go on about. It has continued to beat the rest of the EMs as well. Shouldn't that come to help India when we go bottom fishing, which may very much be in sight?
Well, see, the thing is, we've always been, very positive about the economic recovery prospect and the corporate earnings growth prospect, which I just mentioned. And I think the corporate earnings growth in India is definitely looking much more predictable, much more stable and solid as compared to the rest of the EMs and maybe the rest of the developed world as well. And also that is well supported by the nominal GDP growth. So the nominal GDP growth that we expect, would be close to, say, 13 to 14%. So those are clearly the supportive factors for the broader growth. But as far as the bottom fishing is concerned, Anantara, I don't think we are there as yet, because the word bottom fishing essentially refers to the markets or the stocks or the sectors which have corrected enough. And if you look at India from the global perspective, we are hardly a candidate for bottom fishing. Because we haven't corrected as much, as you rightly mentioned. We've outperformed so many other markets geographically. So I don't think the bottom fishing story is going to play out in India from a global investor point of view. The bottom fishing story could go to some of the value markets, which have corrected far more than what India has done. So my sense is that, I would still continue to stay, on the cautious lines. And as I just mentioned, I don't really see any big money making ideas from the broader market as such.
Appreciate your time. Thanks much for joining in on ET Now with your market expertise.